Sales tax or VAT. Slide 2. So firstly, we should know the meaning of sales tax. A sales tax is a consumption tax charged at the point of purchase for certain goods and services. The tax amount is usually calculated by applying a percentage rate to the taxable price of a sale. A portion of the sale may be exempt from the calculation of tax because sales tax laws usually contain a list of exemptions. Laws governing the tax may require it to be included in the price, tax inclusive, or added to the price at the point of sale. Most sales taxes are collected from the buyer by the seller, who remits the tax to a government agency. Sales taxes are commonly charged on sales of goods, but many sales taxes are also charged on sales of services. Ideally, a sales tax would have a high compliance rate, be difficult to avoid, and be simple to calculate and collect. After studying this lesson, you should be able to the meaning, constitutional framework and components of sales tax in India. Why and how is VAT replacing sales tax? Meaning, importance, advantages and disadvantages, and the methods of collection and charging VAT. SAT. Now let's discuss sales tax in India. It can be understood under the following heads. The power to levy sales tax. Constitutes of sales tax in India. Dealers in sales tax. Interstate trade or commerce in sales tax. Sales tax for inside or outside a state sale or purchase. Sales tax in case of export and import. Sales tax is payable to the sales tax authority in the state from which the movement of goods commences. It is to be paid by every dealer on the sale of any goods effected by him in the course of interstate trade or commerce, notwithstanding that no liability to tax on the sale of goods arises under the tax laws of the appropriate state. The power to levy sales tax are: no state can levy sales tax on any sale or purchase where such sale or purchase takes place outside the state and in the course of import of goods into or export of goods outside India. Only the Parliament can levy tax on interstate sale or purchase of goods. Constitute of Sales Tax Act in India are: a sale or purchase of goods is said to take place when the transfer of property in the existing goods or future goods takes place for consideration of money. The goods have been divided into different categories and different rates of sales tax are charged for different categories of goods. In most of the cases related to the sales tax, the tax on the sale or purchase of goods is at a single point. Under the provisions of some state laws, the assessees are divided into several categories such as manufacturer, dealer, selling agent, etc., and such assessees is required to obtain a registration certificate to that effect. The sales tax or purchase tax is levied on that assessee on the basis of his category, such as dealer, manufacturer, etc., on production of certain forms or certificates, and differential rates of sales tax are levied. Generally, a quarter return of sales or purchases is insisted upon, and the assessee is required to furnish the return in the prescribed form. At the time of assessment, the assessee has to furnish all the documentary evidence and satisfy the concerned sales tax or commercial tax officer. The sales tax laws of the state prescribe the procedure to be followed in case an assessee prefers to make an appeal. Every dealer should apply for registration and obtain a registration certificate to that effect. The registration certificate number should be quoted in all the bill or cash memos. A dealer under Section 2B means any person who carries on, whether regularly or otherwise, the business of buying, selling, supplying or distributing goods directly or indirectly for cash or for deferred payment or for commission, remuneration or other valuable consideration. Dealer also includes a local authority, a body corporate, a company, any cooperative society or other society, club, firm, Hindu undivided family or other association of person which carries on such business. A factor, broker, commission agent, del creditor agent or any other mercantile agent by whatever name called and whether of the same description as mentioned earlier or not, who carries on the business of buying, selling, supplying or distributing goods belonging to any principal, whether disclosed or not. An auctioneer who carries on the business of selling or auctioning goods belonging to any principal, whether disclosed or not, and whether the offer of the intending purchaser is accepted by him or by the principal or a nominee of the principal. Every person who acts in any state as an agent of a dealer residing outside that state and buys, sells, supplies, or distributes goods in the state, or acts on behalf of such dealer as a mercantile agent as defined in the Sale of Goods Act 1930, an agent for handling of goods or documents of title relating to goods, an agent for the collection or the payment of the sale price of goods, or as a guarantor for such collection or payment. According to S3, a sale or purchase shall be deemed to take place in the course of interstate trade or commerce in the following cases: when the sale or purchase occasions the movement of goods from one state to another, when the sale is effected by a transfer of documents of title to the goods during their movement from one state to another. Not all dispatches of goods from one state to another result in interstate sales. Rather, the movement must be on account of a covenant or incident of the contract of sales. There are some instances wherein the goods are moved out of the selling state and yet they are not considered interstate sales. Intrastate sales: stock transfer from head office to branch and vice versa. Import and export sales and purchases. Sale through commission agent or on-account sales. Delivery of goods for executing works. Now let's discuss VAT. Value added tax, VAT, is similar to a sales tax. It is a tax on the estimated market value added to a product or material at each stage of its manufacture or distribution, ultimately passed on to the consumer. Personal end consumers of products and services cannot recover VAT on purchases, but businesses are able to recover VAT, input tax, on the products and services that they buy in order to produce further goods or services that will be sold to yet another business in the supply chain or directly to a final consumer. Now let's study difference between VAT and CST. Under the CST Act, the tax is collected at one stage of purchase or sale of goods. Therefore, the burden of the full tax bond is borne by only one dealer, either the first or the last dealer. However, under the VAT system, the tax burden would be shared by all the dealers from first to last. Then, such tax would be passed upon the final consumers. Under the CST Act, the tax is levied at a single point. Under the VAT system, the retailers are not subject to tax except for the retail tax. Under the CST Act, general and specific exemptions are granted on certain goods, while VAT does not permit such exemptions. Under the CST law, concessional rates are provided on certain taxes. The VAT regime will do away with such concessions as it would provide the full credit on the tax that has been paid earlier. Under VAT law, first, the dealer pays tax on the sale or purchase of goods. The subsequent dealer pays tax on the portion of the value added upon such goods. Thus, the tax burden is shared equally by the last dealer. Advantage of VAT are: identification. The VAT applies to products and services produced within the country. Imports are not charged in the VAT system, but an import tariff equal to the VAT reduces the price advantage of foreign goods. Prevents double charging. The VAT tax system prevents this by having a flat rate and charging only when a value is added to the product. For example, with a 20% VAT tax, when a logger sells ₹1,000 worth of wood, he pays ₹200 in tax minus the VAT he paid on his tools. The next person in the chain, say a carpenter, makes desks and sells them for $3,000. The carpenter would pay $400 in tax because the logger already paid $200. Reduces cost of evasion. In a normal sales tax system based on a percentage of the final sale, the government takes a 100% hit when someone avoids the sales tax. In a VAT system, avoiding the tax at any one stage does not completely avoid the tax. Not only does this give people less incentive to evade taxes, governments who use this method see a greater amount of income than from a normal sales tax. More transparent and neutral. A VAT that requires the seller to put the amount of VAT already paid on the sale of receipt increases transparency. This helps tax authorities track how much VAT has been paid and whether a business is trying to evade the tax. Disadvantage of VAT are: the main downside to the VAT system is the increase in the amount of accounting a business needs to perform. This can especially hurt developing countries and small businesses. Developing countries may not have enough people with knowledge of accounting principles to help business keep track of the tax. Small businesses may not be able to afford to devote resources and time to cross-checking where VAT is coming from. It is regressive. It is not economical. Items covered under VAT are: VAT in India is imposed only on money-making articles, and so resources such as diesel or petrol are exempt from this tax. Certain products such as sugar, textiles and tobacco were exempt from VAT for a year but now are taxed as per the state norms. All business transactions carried on within a state by individuals, partnerships, companies, etc. will be covered by VAT. More than 550 items would be covered under the new Indian VAT regime, of which 46 natural and unprocessed local products would be exempt from VAT. About 270 items including drugs and medicines, all agricultural and industrial inputs, capital goods and declared goods would attract 4% VAT in India. By the method of collection, VAT can be accounts-based or invoice-based. Under the invoice method of collection, each seller charges VAT rate on his output and passes the buyer a special invoice that indicates the amount of tax charged. Buyers who are subject to VAT on their own sales, output tax, consider the tax on the purchase invoices as input tax and can deduct the sum from their own VAT liability. The difference between output tax and input tax is paid to the government, or a refund is claimed in the case of negative liability. Under the accounts-based method, no such specific invoices are used. Instead, the tax is calculated on the value added, measured as a difference between revenues and allowable purchases. Most countries today use the invoice method, the only exception being Japan, which uses the account method. Levies of tax under the VAT are: sales tax or output tax included deemed sale within the state. It covers all kinds of transfer of goods under the Sale of Goods Act, including deemed sale, that is transfer of goods by the way of works contract delivery of goods on the basis of a hire purchase agreement or installment, etc. Purchase tax including deemed purchase within the state, the tax paid on purchase of goods in certain circumstances. Composition tax, that is in lieu of tax by the way of lump sum tax. This means the amount paid by the dealers like retailers whose turnover is below the specified limit of the taxable turnover, that is allowed to pay the amount at his option. Now let's discuss SAT. SAT refers to special additional tax. It may either be independent of VAT or in addition to VAT. It may be levied at the first stage or at any stage as may be notified in the state. The SAT will be levied on the sale of prescribed goods such as liquor, petrol, aviation turbine fuel, diesel, raw opium, tendu leaves, natural gas, etc. The rate on SAT would be levied as prescribed in respect of the relevant schedules or notifications. SAT will be payable along with the ordinary sales tax that is payable under the Act. This is done by furnishing returns within the prescribed time and in the stipulated form. Now let us check if we have understood the various concepts discussed in this lesson clearly. The value-added tax amount is usually calculated by applying a percentage rate to the taxable price of a sale. Right or wrong? Wrong. A dealer under Section 2B means any person who carries on the business of buying, selling, supplying or distributing goods directly or indirectly for cash or for commission remuneration or other valuable consideration. Right or wrong? Right. Under the CST Act, the tax is collected at one stage of purchase or sale of goods. Right or wrong? Right. Now let's revise what we have studied till now. Sales tax in India is that form of tax which is imposed by the government on sale or purchase of a particular commodity within the country. It is imposed under central government central sales tax and the state government sales tax legislation. Normally each state has its own sales tax act and levies the tax at various rates. Apart from sales tax, certain states also impose extra charges such as works contract tax, turnover tax and purchaser tax. Thus, sales tax plays a major role in acting as a major generator of revenue for the various state governments. Sales tax is gradually but effectively being replaced nearly in all Indian states by value-added tax VAT, which is nothing but a general consumption tax that is assessed on the value added to goods and services. It is the indirect tax on the consumption of the goods paid by its original producers upon the change in goods or upon the transfer of the goods to its ultimate consumers. It is based on the value of the goods added by the transferor. It is the tax in relation to the difference of the value added by the transferor and not just a profit. Special addition tax will be levied on the sale of prescribed goods such as liquor, petrol, aviation turbine fuel, diesel, raw opium, tendu leaves, natural gas, etc.